Hello, 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 hello. What's going on, everybody? Hello, hello, hello. Welcome to Al Stock Trades. Hope everything's doing well with you guys. Let's go. All right. So my apologies. I was a little late to the live here. I wanted to first start off by, just saying here, if you guys like coffee, to my coffee connoisseurs, I got some cardamom. For folks that don't know what cardamom is, it's a little spice, has a little minty, refreshing flavor. And I had, you can get it grounded. I got it grounded because I put it in my coffee, and I have a little espresso machine that I just put a little bit of my cardamom and with some nice espresso. Obviously, you can make it into a cappuccino, and it's just one of the best. It's a really good, refreshing drink. So, all right. Take a little sip there. All right. So, I recently watched the All In podcast regarding Chamath Palihapitiya, remarks regarding his IPO, CB, and all the names that he SPAC'd. And I believe this would have been very helpful for the Clover community to hear about, and just to basically show you guys kind of the data backing it and whatnot. But first, before you start, go ahead and give the video a thumbs down. I'm just kidding. No, give it a thumbs up. And we're going to go ahead and start with just this analysis real quick here. So first things first, we talked about this in our last video, I believe, but it's just good to kind of bring it back to the surface, but give you a different graph. This graph is from a leading economist, Dr. Yardeni. A lot of folks on Wall Street follow him. I've been following him for quite some time. And overall, what you see here is obviously the S&P 500, looking at equal weighted versus market weighted. But the biggest thing here is we're looking at the dashed line, which is the 200-day moving average. And what you can see here is that the 200-day, stock, the whole market right now has gone under the 200-day. And I believe only the Magnificent Seven is honestly carrying the market right now. And, my response to that is, what do you expect? The economy is kind of jittery right now. It's a really weird one. You have interest rates, very high, the highest that, we've seen for quite some time in terms of the rate of the hikes, not so much the actual interest rate. We have over trillions in dollars in debt. There's a, Middle Eastern conflict along with a Russian-Ukrainian conflict. And, so there's a lot going on. So I'm not surprised. But the thing that I would like to also focus about here is, look at the Russell 2000. Now, why are we looking at the Russell? Well, because we're looking at small caps, and Russell 2000 is a collection of the 2000 small cap stocks that have gone through the 3000 and all the other ones. So these are kind of the best small caps in a sense. I wouldn't say best, but that's what they say. But overall, from a technical analysis perspective, you can see this decreasing wedge. And you see that this wedge has essentially been broken. So there's a higher probability, if you were to essentially, that's the whole thing with technical analysis, it's probability. Fundamentals is something else. But if you essentially were to flip a coin, there's a high probability that this may go lower. Now, you may ask yourself, you're like, Al, Clover was doing so damn good. And because the Russell 2000 was going up, but now the Russell 2000 is going down. Okay. Now, obviously, if Clover ends up becoming profitable, then the equation somewhat shifts up, but the relative pattern will stay the same. So something that you could do is do for all, there's some day traders out there, and I'm more of a long-term investor, but some day traders out there are like, I'll play with Clover, but I'm just going to follow this technical analysis grid. And once it starts recovering, I go in and I just wait till it hits this. I mean, you could have done this trade pretty much, 1, 2, 3 times, and done really well. How many times did it go up 30, 40%, right? But again, I just wanted to give you this perspective. So now what we're going to do is we're going to shift to Chamath. Yeah, there's Jason's face. Let's go ahead and stop the share screen here. And my apologies for the, no camera. It's just the internet right now. I'm traveling, so it's good to kind of limit the video so we can focus more on the audio, so it doesn't disrupt the video quality. So let's go ahead and let me see Chrome here. Also share audio. 3. All right, so let me know if you guys see the audio or see the audio. What kind of retardedness is this? Hear the audio, and then let's listen to this here, and we'll stop it to make remarks.
Where the employees were all laid off in late 2022.
But I mean, I have a question for you guys. What turns this around?
I'll tell you what I'm seeing in the early stage. We are seeing many companies come to Founder University, and 2 or 3 people who want to build a company who can't get jobs at Google or Stripe. They're not hiring. So we'll see 2 or 3 developer teams working on a project and then raising $250,000, $500K.
Anywho, if you look and analyze things, Jason likes to basically, I can see the audio, maybe the mushrooms. Right? Jason likes to blabber a lot, likes to interrupt a lot. That's kind of the consensus if you talk to the all-in podcasters that, so Chamath shuts him down right after this and says, he asks the question again, but he asks Friedberg and David Sachs pretty much like, shut up, Jason, please let others talk.
At a $5 to $12 million valuation, and then very quickly getting to 10 to 50K in monthly revenue.
But what about all this money that we need to return so that we can recycle and keep doing this job? What needs to happen, Sachs, Friedberg? What do you guys?
Sachs, Friedberg. Shut up, Jason. Let me. I want to hear other people's opinion.
I think needs to happen to crack, because like the 3 IPOs we've had have not fared particularly well. And
so he looks directly at the camera. He's like, "Oh crap! Here! I open up a can of worms." So he said the 3 IPOs that we had not fared particularly well. So I'm going to go ahead and restart that, and then we're going to listen to him here. Okay?
Because like the 3 IPOs we've had have not fared particularly well, and the market just seems to get harder and harder for tech companies, even profitable ones, right?
So, yeah, I mean, I think profitability is key. I think that's the great evolutionary forcing function here. It's like a tale of two startups. The one startup needs cash for a long period of time, and the other one's found a path to profitability. The one that's found a path to profitability, they have an infinite number of options available to them. It might take longer to get public or whatever, but they can wait it out because they don't need money. The one that needs cash continuously and will for a long period of time, it's really screwed.
What about the multiple of these profitable companies? That seems to have changed materially as well.
I'll say something that's starting to happen as well, Chamath, is that the public markets are looking at their stocks if they're undervalued. And then Dara at Uber is reportedly planning like buying back upwards of 20% of the Uber shares in the next 5 years.
Yeah. So essentially the argument here, and I think this is what basically, Chamath is trying to allude to, is that yes, we understand that it's getting harder to find alpha in the market because, due to the money supply dwindling and the M1 and M2 money supply decreasing. The biggest issue, I guess, Chamath finds himself and many investors and people that are venture capitalists is that how essentially, what is the underwriting? What is the discount rate do we use now to value a company? What are the evaluations? And to be honest with you guys, to all my Clover Health folks and everyone who watches this channel, we've all been arguing regarding how overvalued the market is. And I think we're getting to a point where, stocks, they're a little over fair value, but they're slowly coming down to a level that is considerably tolerable. There's still obviously some aberrations, but we'll want to go ahead and so listen to this next part because it is important. How you doing, Jackson? Appreciate you making content on this after mentioning Chamath's statement. Absolutely. Hell yeah. We're here to help you guys. We're here to talk about the hard things and talk about things to, not just help you guys. We're here to participate with you guys and be able to have a conversation. So if you guys want to comment down in the chat, again, it's just, have a nice a group of people to talk about these things, because no one's actually having an intellectual conversation about this. It really isn't. And if they do, it's a bunch of nice graphics with a little bit of content in terms of the meat of things. So yeah, I really appreciate you seeing the value here. Thank you. All right, let's go ahead. Oops.
Next 5 years. And then you look at a company like Snap, which is majority controlled with super voting shares. They're still losing 300 or 400 million a quarter. So I think Freeberg's exactly right. Tale of two cities. Some people refuse. And then if the stock is so cheap, people start buying it back. And the freezing of employees and the expenses going down while revenue goes up and earnings increase. I think that's the setup. If you're looking for the setup, I think it's the public market company showing the path to profitability, buying back stock, and then these small companies not getting big.
How does that help private companies go public?
If the private companies follow
again, so that's the issue that Jason's not understanding. Chamath, his statements is, he's indirectly talking about Clover, but he's more focusing on other companies he has a lot of private companies that he wants to essentially, make go public. The problem is that pathway is becoming very difficult, to where it's actually better to become a private company and stay a private company until this shit show ends, then go into public. But the problem is that's how a lot of these venture capitalists make their money. Let's continue.
A suit, and they're profitable and they control costs, and people get greedy looking at how profitable they are as opposed to their 50% growth rate. They start looking at their increasing earnings and how much cash they're throwing off. And I think that's starting to trickle down through the startup ecosystem. People are trying to get to profitability quickly.
I don't know.
You asked, the question was, can people turn it around?
I think,
if they do, that's what it's going to be, is profitability.
Yeah, I think you guys are kind of talking about two different things. Sure.
Exactly. David Sachs is hitting it on the note. Jason's talking about something else. Chamath's talking about something else. And we want to focus a little bit on what Chamath has to say. I get what Jason's trying to say in terms of stock buybacks to increase the value. It's been going on since the 80s. But yeah, let's go ahead. Let's continue.
Any particular company can still get its house in order and create a great business, and they'll eventually get, liquidity. They'll go public. The question is, I think what Chamath is getting at is that the exit comps have changed. If you were a tech investor, or let's say a real estate investor, before the regime change, you were underwriting to a completely different exit comp.
So that's the point, is it's just underwriting. It's all about the underwriting. What is the discount rate? What is the intrinsic value? What is the evaluation metrics now for companies post this easy money supply turning off?
And now those exit comps have totally changed. And so it's going to be very hard for those investors to make a good return.
So they're going to lose their money like Instacart. Yeah.
I'll give you a mathematical example just to illustrate what David just said. If you have a company with 300 million of ARR, you are in a rare group of, say, 30 or 40 companies, period. Okay. So very, very, very few companies get to that level of scale. But if you are at 100% net dollar retention, okay, which means that you're kind of treading water, essentially. Your customers may grow, but the value of each customer isn't particularly growing. So, you have
Now, very quickly, he said 300 million of ARR. Just very quickly for folks that don't know that, ARR, it's just another way of looking at the percentage rate of return expected on an investment compared to the actual initial investment cost. We talk about it, I believe, in our book, How to Find a 10-Bagger. All the terminology is used, but just wanted to throw that out there, so folks have an understanding.
Pretty nominal growth. That company now comps to roughly 3 to 5 times ARR. Now, the problem is, if you go and look back through Crunchbase or any of these other sort of PitchBook, the number of companies that traded above $1.5 billion valuation as a SaaS business, there's like 70 of them, but there's only 7 of them that have 300 million of ARR. So what happens, guys? Like, the jig is up. Okay. What's going on here?
Consolidation, I guess. And some of them will flame out. Look at Instacart. The people who were the last 4 rounds, they either lost money or broke even. So, and that means time adjusted versus what they could have made in the markets. They lost money. So
what happens if Stripe is only worth 30?
How much has been invested into that company? What's the total?
So if Stripe is only worth 30 billion, we're in a big problem. And that's what Chamath is trying to say. Stripe is the most well-organized company, well-run. Heck, Twitter X uses them for payments. They are the creme de la creme private company right now. Everyone uses them. I use them for our Mastering Stock Market course, which you can get $1,000 off right now because of Black Friday. But the thing is, if they are valued at an undervalued rate, then what happens to other companies that are subpar? It's like Stripe is like your A student. And if your A student has this evaluation, then the market is going to use that as a benchmark, if that makes sense. Let's continue.
Total paid in capital.
Again, I think we all want Stripe to be worth 100. We want it to be worth
when he says 100, he's talking about billion, 100 billion, 200 billion.
200 billion. Because it would help. Frankly, it is the rising tide that lifts all boats. But if unit level profitability is scrutinized and then comped appropriately to the public markets, as Zach said, we're going to have to take that signal and apply it to our entire portfolio. And so it goes all the way back to eventually the seed and the Series A as well, which is really good, Jason, as you've said many times, just getting the inflation under control and in check. But it will mean not just changing valuations, but it will mean changing salaries, right? It will mean totally different equity packages.
A lot of hard work. Yeah.
I almost think that maybe none of the hard work has actually yet started. So I don't know. I'm just putting that out there, guys. Do you think that we've all just kind of been hoping maybe that all of this would pass, and now we're getting more and more signals that we actually have to do a pretty hard valuation reset?
Yeah, I mean, if you look at the altimeter charts that Jam.
So again, ladies and gentlemen, we don't really have fancy charts like this in terms of looking at the EV enterprise value over the revenue multiples regarding SaaS businesses. But I give you, and I try my best into basically giving you the data. So we've been talking about this since a year, 2 years ago, but the proof is always in the pudding. So as you can see, on June 7th of 2023, 8:34 p.m., this is a graph that I put together that looks at the SaaS Capital Public Index, which is essentially the revenue multiples of all the SaaS companies that exist that are publicly traded. And you can see that 2020, the SaaS index has increased to a level of 16x, meaning that, again, the collection basket of SaaS companies, there were 16x revenue multiple. There obviously, were ones that were 50, 80x revenue multiple, right? So a lot of folks that were purchasing our Mastering Stock Market at this time, our stock market course, they're like, hey, Al, should I be investing in Snowflake? I'm like, no, because personally, from an educational perspective, Snowflake is, really overvalued, given that it is, its revenue index multiple is incredibly high. But, the Warren Buffett thing, but obviously the proof is in the pudding. If you look at the SaaS, if you look at that, it's literally from peak to trough, 62% down. Which is obviously reflective of kind of, if you look at 2021, it's reflective of this graph that we basically have here, right? Again, what we basically see now is we are below trend line, right? In fact, we are slowly trying to creep up above the simple moving average. Yes, you can do simple moving averages on any data that you can collect. But if you were to draw a line here and find the last time we were at these levels, you would see basically 20. Oh, shit. Sorry. You know what? I realized that I'm not even showing you the graph. Hold on. Whoopsies, hold on. So all this time I was talking, I wasn't even showing you the graph. My apologies. So as I was saying here, if you look at the graphs regarding EV over the NTM for the revenue multiples, you can see that he'll be talking about it right now. You can see that in 2021, the revenue multiples were essentially anywhere between 15 to 20x, but now they've gone down to 5.7. So if you look at it, we've been ahead on this. And, as I said, the proof is in the pudding. Since June 7th of 2023, we've talked about this. In fact, we've talked about it in 2021 and 2022. While it was up here going down, we're like, hey, guys, I need to find a trend line, right? So if we were to look at this, 2020, 2021, the SaaS index was near 16. Like I said, this is a basket of SaaS stocks that are publicly traded. Obviously, there are some that were higher than that. In fact, there were folks that were with us in the Mastering Stock Market course here that were talking about Snowflake. And I said, hey, guys, this is definitely overvalued, because if you look at it from a SaaS index perspective, you're essentially buying it, assuming that this trend is going to continue. And as you know, there has to always be kind of a Brownian motion type effect. What I was saying, because I didn't have the graph pulled up here, if you were to go back here and look at it and see the last time the SaaS index revenue multiples was in this territory, you go back, you'll find it here. And that is easily 2015, 2016, 2017 levels, mostly 2016 levels, as you can see here, right? So that's what David Sachs is going to mention. I just want to basically point it out to you so you can see that's what he's referencing. Because again, a lot of these venture capitalists, they talk about these things. For me, it's taken me over 10 years to understand these things. And sometimes they just talk about it and they're really right there targeting a group of folks. Retail investors, they're probably going to understand 20% of it, but not really. I'm here just to basically break it down to you and explain it to you in a way that's you can make use of it. So essentially, we're looking at 2015 to 2016 levels of evaluation, which I will continue after we watch this video here. Just wanted to basically kind of dissect this. And again, my apologies for making a long video, but again, this requires a long analysis. And again, you don't want something 3-4 minutes short, you're going to get 3-4 minutes of shit value, right? Okay. Let's go ahead and stop screen and let's share it again, but this time with the audio, shall we?
Chairman Ball has put out. I mean, the valuation levels are returning to, let's call it the pre-COVID mean. In fact, they're slightly below the pre-COVID mean because the 10-year Treasury has a higher rate. So yeah, we're going back to something that was more like, 2015 levels of valuation. And maybe,
as you can see, he basically says it, 2015, 2016 levels of valuation, which I just showed you from the graph. So you guys should understand that. Please type in the chat if you don't, so I'll explain it better.
even slightly worse, again, because long-term rates are higher. So cost of capital and hurdle rate are higher.
That's what I'm saying. I'm seeing 2012 valuations. Valuation of Uber when I invested was $5 million.
Yeah, let me just tell you, it's a lot harder.
Again, Jason actually said something really valuable. So no offense on Jason, Jesus, right? So he said that he invested in Uber in 2012. He's seeing 2012 evaluations, and he invested Uber at around a $400-500 million valuation. Now, if you look at Uber right now, it's sitting at an $86 billion valuation, meaning that he approximately 170x'd his money. Well, if you look at Clover Health right now, it's currently sitting at a $400-500 million valuation, the same thing right now. So, I understand that the concept of these venture capitalists are hurting, and I get it, but it's actually an opportunity for us because Chamath Palihapitiya, yes, created a vehicle, an IPO, where investors can jump in on a company and be able to make outsized returns. But again, he was also, in a way, playing a poker face because he got in at a $5 price. Ladies and gentlemen, right now we're getting in at a 90-cent price, talking about a 99-cent store. I mean, come on now, right? So, but we'll continue and extrapolate the data after.
Harder for people to make money when the money supply is shrinking than when the money supply is growing. For obvious reasons. When the money supply is shrinking, it's like you're playing a game of musical chairs. And you're just hoping that you still have a seat. Whereas when the pie is increasing, it's a lot easier to get like a piece of it. But when the pie is shrinking, it's a lot harder to get a piece.
Musical chairs, as you described it, is literally the description of the venture capital industry. And
exactly. So we're going to go ahead and just stop sharing right now from this. And then we're going to just kind of do some analysis. So very quickly, let's go ahead and reopen up this PowerPoint presentation we have. And let's take a look at this here. So this is the financial 10-year for Apple. Okay. And this is the Apple company. They just, they have around $383 billion in revenue. What I did was I went ahead and I covered up 2017 to 2023 TTM. And I just focused in between 2013 to 2016. And I calculated the intrinsic value by taking the net income difference from 2013 to 2016, as well as the revenue difference. And I essentially got an approximation growth of around, which I can just show you here, at around 8%. I used a free cash flow of $51 billion, which I basically got from 53 billion here, but I ended up using 51. I used it in 2017, which is good. It's undervaluing it. You want it to be lower. That's honest. That's good. And then I just used the free cash flow from that angle. And I got a stock price of anywhere between $15 to $46, right? But then what I did was then I went to Apple and I looked at the stock price of Apple, right? And then after going to the stock, okay, that's on Apple. It's AAPL, but whatever, it showed it to me. Who cares? So if I went ahead and did this and I go to 2015, which is, right around here, I see a stock price of anywhere between $30 to around 2016, $25. So let's say $25 to $30, right? So I did my intrinsic value calculation with Apple, and I essentially saw that we are in 2015, 2016, the discount rate was approximately 15% from a creme de la creme company like Apple, right? Which means that if we were to do the discount rate for Apple in regards to that, then for like Clover, then maybe we might need a 20% discount rate, hence why it's not like a premium company. So if we were to do that really quickly and just say that if we were to underwrite and reevaluate Clover Health, they have what, $21 billion for this ending year. We multiply 5% to estimate the future free cash flows, which obviously is difficult since they are free cash flow negative now, but they're slowly going into positive. We're going to just use the number 100, just again really being extra conservative. We're going to go 10 years. We're going to do a 15% growth rate. But then guess what? I'm going to do a 15% discount rate. But first, let me just kind of do whatever the shares here. It's minimal. We're just trying to get near the number. But I'm going to go ahead and do a 15% discount rate. A 15% discount rate is $3.74. Okay. So essentially, the bear case is what Clover is worth technically right now if it becomes profitable, which makes sense because the numbers make sense right now. That's what the market is evaluating right now. The market is essentially at 2015 levels right now. Right? Again, will it ever get to, 2020, 2021 levels? Of course it will. Look at the dot-com bubble crash. Look at 2006. Stocks do that. They go from an era of essentially logic to illogic, right? But again, this is Clover growing at 15%. Let's say if Clover is able to maximize this and grow at 30%, right? Then we can see a stock price of $9.98. But let's say they start turning on their revenue growth machines, and let's say Chamath Palihapitiya's greatest fear of a reset underwriting evaluation for profitable companies is sustained at a discount rate of 15%, then let's go back to when Clover used to grow at 55%. That means the max you could potentially see Clover is around $40, $47, which if you don't remember in the beginning of our videos for our stock trades, in the beginning videos, I stated that the average stock price for Clover should hover around $40-ish, around $42. Again, if this doesn't make sense, I recommend rewatching this multiple times because there's a lot of terminologies used here. And if you want to learn about these terminologies, we do have these books available on Amazon. For $14.99, all profit proceeds go to charity. Or if you want access to the Mastering Stock Market course, you could go ahead and use the link Black Friday to get one of the biggest sales ever before prices increase. And then another thing I just want to show, just a tangent, just a weird tangent, is if you go to the economic calendar here, I wanted to just show you this. Now you guys have access to the economic calendar directly from the Federal Reserve. So let's say, for example, we want to look at the producer price index. You just click that and it'll basically send you to the direct U.S. Bureau of Labor Statistics. So you're able to keep track of essentially all the data needed for you to essentially, to see what's going on with the economy. So you have access to this. Again, we want to put it all in here to make it easy for you. Okay. Let's go ahead and take a look at these questions and let's go from there. Okay. So thanks for all the insight and sharing knowledge, holding and adding Clove, the only stock in my portfolio, small investor here, no point to diversify now. Yeah, I think Warren Buffett talked about how, Warren Buffett has around 50% of his portfolio, I think, in Apple, which is insane. Peter Lynch has a different philosophy, definitely reading his book. But Chamath sold when Clove squeezed at 28. I don't think he sold at $28. That's incorrect. He did sell a little bit of SoFi at around $20-ish early in the young 20s, and then ended up purchasing more Clover. But then he ended up selling out of Clover, not all, we don't know, at around $1.50-ish, $1.70-ish. The reason why I say I don't know if he sold out completely is he sold under 5%. In fact, he did 4.99%, which is kind of like a poker move because we don't know if he sold more, because if it's less than 5%, then he doesn't have to report the other sales. But again, why would he do 4.99%? He's just trying to do a poker move, right? Nick, go to the filings. Plus, he was in a lockout period, so he couldn't have sold during the squeeze. Exactly. And, Sean is one of our Mastering Stock Market members. Again, this is the type of analysis we do. We're always looking at the filings. We're always doing due diligence. I understand there's a hefty price associated with the stock terminal, with the mastering course, and I get it, which is why we created the stock terminal for $19.99 a month. We try to make it fair. But again, the data is expensive. And it's really hard to put it all in one centralized place. Another thing is the people that come in our platform are very serious about investing. They're very serious about being long-term investors. They're very serious about trying to change their life for the better. So they're all growth-minded set. So that's the type of people we want to come in here. We don't really want those, quick AMC, no offense to AMCers, but just kind of, the gambling mentality. We don't really do that here. We want to do really strict analysis here, okay? But yeah, it's definitely, this was a 30-minute banger, a really long video here, guys. But again, I wanted to talk about other things in terms of research, but I felt like this deserved some attention, given that, David Sachs did point out that we're approaching 2016 levels, 2017. And again, I just want to basically point this out clear, ladies and gentlemen. I just want to be very clear with you, okay? Listen, when you look at these folks, okay, well, let me go ahead and just look at here. Let me zoom on here. When you look at these billionaires, right? I mean, he's like, 400, 500 million. He's a billionaire, and I believe he's a billionaire. Ladies and gentlemen, you don't have to be extraordinary to be rich. You don't have to be extraordinary to be a billionaire, right? You just have to have the data. You just have to have the right set of data. And these folks have had access to data. This guy, David, ended up selling a company, I believe, to Google that measured the weather and mathematically calculated how much rain's going to happen for vacationing and whatnot. Again, it's all about data and how you essentially think as a business person. These people obviously are smart, but at the end of the day, if you were to graph all these people and look at their IQ, it's really interesting. You don't really see that the IQ is actually higher. In fact, if you look at neurosurgeons, you would think a neurosurgeon's IQ is high. Actually, I beg to differ. I honestly want to say internal medicine doctors, their IQ is higher. I would say it's just kind of the stereotype. The point what I'm trying to make to you regarding this whole IQ argument is that you too can make a difference in this world. You too can become rich. You too can become wealthy. It's just the life and the information to get financial literacy, it's just stacked against you. Which is what I've been trying to do. People don't have to have rocket science of a brain to understand. It's very clear. Morningstar went ahead and eliminated the 10-year data. I brought it back. Why is a billion-dollar company eliminating this data for retail investors? Because this works. This information works. You don't believe me? Well, look what Warren Buffett does, right? Go read Benjamin Graham, The Intelligent Investor. Go read the security analysis. They removed this from retail investors, and me on my own with my developers and my beautiful community in the mastering, we're basically going ahead and working from this and building it from scratch, albeit slowly, but we're building it, right? But it's just unfortunate because the data is stacked against you. And if you surround yourself with like-minded people that are essentially want to push you, people that want to uncover the truth and want to do the due diligence and want to get better, then obviously you are what you essentially surround yourself with. I mean, I leave you with this. I remember seeing an image of a meme, not a meme, just a picture, right? And it was of a tomato. And the tomato was colliding, and it was right next to another tomato. But that tomato was rotten. That tomato was very rotten. It was literally dying, right? And if that tomato essentially, the side of the tomato that was touching the rotten tomato, it became rotten too. But the other side of the tomato was so beautiful. Essentially, what the point is who you surround yourself with determines essentially your future. Your habits determine your future. You don't get to decide your future. Your habits decide your future. Okay? Rewatch the video and then you'll understand what I'm talking about, right? Overall, that's all I have to say right now. I guess the point that I'm trying to make with these billionaires is that all you need is the data, right? You see how like David Sachs was saying, oh, we're at 2015, 2016 levels of evaluation. You go speak to Joe Schmo on the street. We can do a little TikTok challenge where I give people $100 if they understand what the SaaS public index is. Not many people understand this, but if I show them the graph, they're going to get it. Like, oh yeah, of course it's at 2015, 16 levels, because all I did is I just can draw a line here like a monkey, and I draw a line down here, and I can say 2016 levels. That's what I'm trying to basically say. I'm trying to say this is not hard. It just, you just need the equipment. It's very easy to go from point A to point B if you have a car, but if you have, no legs, then you can't do that, right? Which is what they've been trying to do for years. Wall Street has been doing. Anywho, ladies and gentlemen, that's all I have for you guys. It's always a privilege and honor to be able to be here and share with you my insights. Please go ahead and like this video. And if you haven't checked down the links down below, we are giving $1,000 off our mastering course. And we also have 18 months of financing from a firm we've partnered with, giving, trying to really democratize financial information. God bless all of you, and I'll see you on the next one.